I'm Jean Gray, founder and publisher of American Entrepreneurship Today, a website that brings news and valuable information to entrepreneurs, innovators, and investors all across America. Our podcast series, Experience Voices, explores the journeys of very successful people in the entrepreneurial arena who are open to sharing the key elements that led to their great success. Our guest today is Dr. Harvey Homan, who has led and helped advance numerous life science companies from inception through maturity. He has been a founder, director, CEO, investor, and advisor to early-stage pharmaceutical, biotech, medical device, and digital health companies. This follows a successful career as a corporate pharmaceutical executive in the US and UK, where he had leadership in driving product development for over-the-counter brands, including Bayer and Midol. In the two therapeutics companies that he led, he raised over $7 million. He is an active angel investor through Keiretsu Forum Atlantic, where he serves as the chapter president of the North Jersey Group. Keiretsu Forum is consistently ranked as the #1 most active angel investor network by Angel Research Institute. In 2021, Dr. Homan co-founded MetasTx to drive the development of novel drugs to treat and prevent metastatic cancers. Dr. Homan and his two scientific co-founders have secured over $3.5 million in research grants, creating a foundation for the company to move forward. They are seeking a second funding pursued by Keiretsu Forum Atlantic, and which will be used to accelerate IND-enabling studies for its lead drug. Dr. Homan will discuss how he navigated fundraising and also the steps that he took to overcome some of the most common startup challenges. Harvey, welcome to Experience Voices.
Thank you, Jason. It's a pleasure to be talking to you today.
I know you both as an entrepreneur and angel investor, Harvey. Let's kick off by you sharing the opportunity that was presented to you that so compelled you to do another startup.
Well, thank you. So MetasTx LLC is driven to create novel therapeutics to treat and prevent metastasis of cancer. We are working off of a platform based upon an enzyme, P21 kinase, that seems to be very important in several aspects of cell motility and metastasis.
So what was the opportunity that was presented? I see you're the CEO. How did you become aware of the startup or the technology that motivated you to get so involved?
Yeah, well, thank you for that question. It actually all came from our mutual involvement with the University of Georgia College of Pharmacy. I received my doctorate in neuropharmacology many years ago from the University of Georgia College of Pharmacy, and I've been an active alum and came to know several of the professors at University of Georgia College of Pharmacy, two particularly, Brian Cummings, who is an expert in cancer, in toxicology, and in lipid and nanoparticle formulations, and Samana Shenoy, who's an expert in cellular mechanisms, particularly with a focus on cytoskeletal structure. We got to know each other through my visit there, and I learned more about the research they'd done. And last year recognized that they had a stream of research going back to 2007 that resulted in 35 publications and formed a fairly compelling story about a lead formulation, a lead drug that they developed that I was certain was at the right stage to convert to translational research and to taking forward to become a treatment therapeutic for cancer and cancer metastasis. So I approached them.
Was tech transfer involved in this as far as the university?
No. Tech transfer came in at a later stage. University of Georgia has actually been quite active in creating something called the Innovation Gateway. And I've been involved somewhat in the Innovation Gateway. I've also been involved with the strategy development at the University of Georgia College of Pharmacy to increase the focus on translational research and commercialization. But this was my direct reach out to the two scientists responsible for all this work. I learned that they had already had a patent in process, and then approached the university about obtaining that.
So how did you go about forming your team? A lot of people are always curious as to someone's a founding entrepreneur, and then all of a sudden they have a lot of credentialed people involved in their startup. So how did you go about forming that team?
So, I think one of the most important aspects of a founding entrepreneur is the depth and breadth of their network. And I have been in business for many years. I've created a tremendous network, about 2,000 connections on LinkedIn that I regularly look through and correspond with. So, Brian, Sam, and I brought very complementary skills as the three founders of this business. Sam really is the basic scientist. Brian focusing on the formulation and a little bit further upstream studies demonstrating the effectiveness, and me focusing on creating the business, laying out the business plan, and then reaching out to people that I knew or that I was introduced to from other people in my network, and asking them about becoming part of the team. We built an extraordinary team of well-known scientists and business people. In the science area, we really have people with deep experience in cancer therapeutics. One of the people, Jackson Gibbs, Dr. Gibbs, spent 30 years in global pharma, 23 of it with Merck, where he was senior director of preclinical pharmacology for oncology products. And other people like him, including Sandeep Prasad, as we decided to focus initially on prostate cancer, who was a noted urologic oncologist. So I reached out specifically to people who I either knew personally or was introduced to, who had depth in the areas that we knew we needed to be expert in to make this successful.
So what's the initial step in the formation of the business entity? Did you, the three co-founders, just divide up the ownership 1/3, 1/3, 1/3, or did you make some other type of assessment in how the ownership structure would be?
Yeah, that's always a decision that you need to make on a company by company basis, based on how much time each person has to devote to it, what their interest is. I was really compelled by the fact that both Brian and Sam were very enthusiastic about developing this company. They understood the potential for this technology as making a huge difference in cancer patients' lives, and were motivated to do that. This is something I've worked with a number of tech transfer departments at universities, looked at a number of opportunities over the years. Not that I've done that much in the last few years. I didn't expect to go back to this. I was enjoying my career as an investor, but I've worked with many universities and found often that the pivotal scientists, people who've done the work that's led to the patents, have moved on in their career, or less focused on what the patent's about, and are not really enthusiastic about engaging and moving from academic research to translational research and business building. Sam and Brian were very enthusiastic about it. And when we approached, tech transfer, and we approached the people responsible for the Innovation Gateway, everyone at University of Georgia was, enthusiastic supporters of what we wanted to do. And it went along easily. So, as I said, it differs from institution to institution and from person to person in terms of their interest and willingness to shift from an academic career to, becoming entrepreneurs. And I wouldn't say that this is either Brian or Sam's primary focus, but they've devoted really significant, extraordinary amounts of time to it, and are entirely engaged in building the business.
When you chose to formalize the structure and sort of the legal creation of it, which I guess is just about a year ago, was the formation of it requiring at least some minimal capital from each of you or from one of you? And I ask this question because, typically startups then move on to family and friends. So as we're chatting, I have a lot of curiosity as to, how do you keep the entity, the startup, moving forward? You need to inject funds or you need to find funds. So how did the very first step was, the three of us are going to write a check and we're going to drop it into the bank, and then I'm going to go out and do family and friends. How does that dynamic work?
Yeah, that's a great question. And again, it varies from company to company. So we each invested a small amount initially, and then much of the business was driven off of my credit card. As we continued to, move through the steps of formation, we incorporated in Delaware, we registered in New Jersey, we formed the company as an LLC. We think we know there are significant advantages to early investors to be an LLC as opposed to a C Corp, and of course, tax advantages. So we paid for the first several months ourselves. We actually only raised the family and friends over the last few months. We closed it in May. And up until that time, we were self-funding. We've also shown a real commitment. And, as an investor, it's really important for me to see that that the people involved in the startup aren't doing this, as kind of a side venture, as something that's, an evening affair. I want to see them be really vested in it. And one way of vesting is with cash. The other way of vesting is none of us have taken salaries since we started this, and we're not playing any games with that. We're not, accumulating deferred salary. We are dedicating, our time to this, as, our participation in, if you will, sweat equity to the company.
I think it's very hard for when a group of first-time entrepreneurs, well, you're a seasoned entrepreneur and angel, but those going around the first time and they've got 2 or 3 people that they think are going to take their startup forward. A lot of what you just said about making a cash contribution or having the passion and the effort, what would you say to them in having each person that's entering the startup declare how much time they are willing to put into the venture once you've set it up as a legal entity? Is that a big hurdle to come over, or do you have some pointers when these young entrepreneurs, they've got a lot of passion but no experience, and then they're trying to figure out how to divvy up the responsibilities?
So I think it's absolutely requisite, Gene. It's a great question again. You need to have employment agreements. You need to have things clearly reflected. In the case of an LLC, it's referred to as the operating agreement. The operating agreement did take quite a bit of time and effort to develop. We had good, support on that from legal counsel. You can choose to do that, or you can choose to do a C Corp, and then you're, essentially writing bylaws as opposed to an operating agreement. But you have to clearly have those things in writing. You have to make sure that you have serious discussions about it. The academics are restricted in the amount of time that they can put into a company versus their contract time to the university. Generally it's around 20%, but that's kind of 20% of a 40-hour week. And you're looking for people who aren't intent on working a 40-hour week and are going to be willing to put in extra time into it. And, that's something that Brian and Sam have been consistently willing to do and that I've always done. I mean, our workday doesn't end at 5 in the evening and it doesn't start at 9 in the morning. I tend to be an early riser. So I'm generally at my desk by 4:30 or 5. And I'm quite happy with going back and spending a couple hours after dinner. So I find that, we work around, responsibilities that Brian and Sam have by working on the hours that they don't have to be in class. They don't have to be at meetings. But it all comes down to, how much enthusiasm people really have for it. And, I think over time, it's something that you have to always be aware of and willing to change. You start out with whatever you agree to in terms of the allotment of shares, the separation of ownership. Over time, it's going to become clear where people's, ongoing and forward-looking contributions are able to be. And that gets adjusted. It gets adjusted as you do, successive rounds funding. Sometimes it gets adjusted on the moment because it needs to be. Again, I think it's absolutely critical. One thing I feel really good about, we have very open, candid discussions. We have typically an 8 a.m. Monday meeting to talk about what we're doing for the week. We have a midweek meeting every Wednesday evening. And then we generally will have a wrap-up on Friday. So we have formal meetings, but we also have a lot of informal exchanges either between two of us or between the three of us.
Now you have your team in place and you've worked through a lot of the structuring issues. You then go forward from our prior conversation to pursue family and friends for more substantial amount of capital. Did you tie that outreach to any particular milestone or how you presented to family and friends the timing of them getting involved?
So we really tied it to when we had our strategic plan in place and were ready to spend money externally, ready to start spending money with a contract manufacturing development organization, start doing the non-GMP manufacture of our drug, but clear milestones, clear objectives that we needed to spend cash on. We weren't spending cash on, a fancy office. We weren't spending cash on equipment. We were, relying on the fact that we all had offices, we all had computers, and, at some point in time, it'll be appropriate to become more formal, but we didn't do that early. So we started raising money with family and friends about 6 months into the venture, after we were very confident about the strategy that we were pursuing, after we had developed a business plan, tested the business plan through a number of, contacts in the network who read and provided us feedback. And then, for us, I guess the word friends, the word friends is an interesting one. I mean, these were not generally social friends. I have a very large network of friends whom I've invested with at Keiretsu and whom I invested with when I was with Jumpstart, and who are aligned in terms of an understanding of early stage investments and the capacity to invest in high risk businesses. So that's really where our family and friends round came from. And it went quite quickly.
Would it be safe to say that the people you tapped into through your professional network, most or all of them were in a science background, or was there a breakout? There are investors who put money in who did not have a science or a medical background?
Yeah, interesting question. I'd say that almost all, were not from science backgrounds. When I started doing angel investing, I joined Jumpstart New Jersey, partially because I knew a number of the members of Jumpstart. I came to know the organization. I came to know what they looked at. Jumpstart actually doesn't invest in therapeutics. But I was looking to learn angel investing from people who I knew had experience with it. I deepened my relationship with a number of those people, invested alongside a number of those people, learned how they thought about analyzing businesses. And it was a number of those people that I turned to when we were looking for the family and friends round. There were, it was a small round. It was a small group of people. And the investments ranged, fairly significantly from $100,000 investment to a $10,000 investment.
For the first-time entrepreneur who is also trying to find friends and family money, or through, like you said, through a professional network, is there a way for you can share with them or describe the whole aspect of that when future money comes into a venture, it impacts the early investors? Is that something that, because you were a seasoned angel, you knew how to structure it in a way that made positioned it best to bring in more investors, but also protecting your first supporters?
Yeah, that's a great question. The second part of that is very difficult. You can't really protect your supporters. You could think about putting some sort of a non-dilution clause in, but those at a very early stage are really problems, because once you do one, it's going to be asked for down by the next group of investors. So you have to make sure. We brought friends and family in on the same basis that the founders were in. They bought the same class of shares in the or membership, if you will, in the LLC that the three founders had. And it's like buying common stock in a C corp. It's the very basic stock, and what the positive is that you're buying it at very, very low valuations for the company, so that you're getting a relatively large amount of stock or membership shares for the amount of money that you're putting in. Beyond that, there aren't many ways. It's something that you have to be, very transparent with people about what you're expecting to need to do with subsequent rounds, how much money you're expecting to need to bring in, and the dilution effect. But we're looking at a situation where, from the friends and family round to the bridge round, we have more than doubled the valuation, and we're expecting to, probably increase the valuation from the bridge that we're doing now to the Series A, 8 or 10-fold. So, it's the multiplier of the valuation of the company that's providing the opportunity for the friends and family.
One of the most fundamental concepts of raising funds for a startup is proof of concept. So where does proof of concept come in for a therapeutics or a science or medical device company relative to sort of more of the mainstream other types of startups in just simply software, SaaS, consumer products? What was your proof of concept? How did you use that to go forward?
So as I said, that was one of the attractive things about this company, is Brian and Sam published 35 articles on the stream of work that led to our lead formulation that we call MTX 101. And the latter, it started with early cellular studies, in vitro studies, and moved on to some of the more complex and more trusted animal studies that have a degree of, validation in going from showing activity in those models to being a good indicator of activity and safety in the clinical situation. And, I think kind of going back to the question you asked before about whether these were, scientists, I think one of the critical aspects, and something that I see all the time in the companies I see as investors that are run by scientists is scientist is really interested in the science. The investors are interested in the business opportunity. And with the friends and family, it's even more so that you're talking to people who in some cases are not very sophisticated. I would say by all means, if someone's not really able to lose the money they're putting in, that you shouldn't allow them to do it. You want people who would qualify as accredited investors, and you want them to take the time to learn the risks that they're taking on. But in the case of proof of concept, Brian and Sam published articles that showed that the formulation inhibited the growth of prostate cancer, breast cancer, and skin cancer implants into mice. It's called a xenograft study. Those are mice that have been immune compromised, so they can't reject the implant. They showed that it inhibited metastases of the cancer cells to the lungs and to the bone, which are two of the largest or most direct sites of metastasis for prostate cancer. And that varies from cancer to cancer. And then they also showed that the formulation did not cause any toxicity to the liver. It was not hepatotoxic. And that's a frequent issue with many cancer drugs. They also were looking at particularly models for prostate cancer, and most of the current drugs for prostate cancer are called androgen deprivation therapy. They act by depleting testosterone. As a result, they have a very high amount of off-target or side effects, toxicities, such as metabolic syndrome, which is diabetes-like, and extreme tiredness, and some cardiac toxicities. So these were a set of drugs that what they developed looked to be relatively very safe.
So let's take a look at your approachment to the angel groups. I know you pitched at Keiretsu Forum, Mid-Atlantic, and possibly Southeast. So, and I'm really focusing a bit on the milestones that you passed through, Harvey. And so you've got these family and friends. Sounds like you've really used your angel experience to pick and choose people that you were comfortable in accepting money from. But now you're going into angel groups that are very structured. Take us a few steps of how you prepared for it, or even maybe your expectation about it since you were previously an active investor.
Yeah. So, I went to Keiretsu because I've been tremendously impressed by Keiretsu since I joined. And about a year after I joined, I was impressed enough to accept an invitation to start a Keiretsu chapter in New Jersey, which is Keiretsu Forum, Mid-Atlantic, Princeton, New Jersey chapter. Keiretsu is an organization I've been very impressed with. It has several tremendous strengths. One is the strength of the membership itself. It's a global organization. We literally have, I think, 54 chapters throughout the world. 42 of them in North America. We have about 2,500 members in North America in the chapters. In the Mid-Atlantic region, we have about 300 members in Philadelphia, New York, Washington, Pittsburgh, and New Jersey. So it's great, breadth. The process is similar to other angel groups. It starts with an application. I did the application, the same as any other entrepreneur. And as a result of the application, it was invited to what's called screening. And we screened with, I guess, about 10 other companies. And Keiretsu sees about a dozen companies each month at screening at Mid-Atlantic and Southeast. That is an open screening committee. Any member of Keiretsu can participate. We were scored. Our score was very high. And as a result of that, we were invited into the next step, which is presenting to the forums. We presented at the forums, which then there were 4 companies that present on a day and sometimes 2 short presentations as updates. And, we have generally around 60 investor members fall through virtual presentation at those forums. Again, it's evaluated primarily a very simple evaluation. What was good about what you saw? What was not so good about what you saw? Are you interested in investing? Are you interested in participating in due diligence? Are you interested in providing any free advice support to the company? So on those bases, again, the company is selected to go to the next step, which is due diligence. And the due diligence process was terrific.
In the screening part, how much time did they give each of the companies? And then when you went on to the next level, how much more time did they give you? Were you just repeating yourself, or were you also given more time to give a more detailed presentation?
Yeah, that's a great question. So the timing, is similar from one to the other. I'll admit that I believe it was 12 minutes or 10 minutes for the screening presentation, followed by 5 minutes of questioning. The presentation at Forum was a little bit longer in that it was a 10-minute presentation, 5 minutes questions, and then 5 minutes of feedback. And the feedback was very, very helpful from the members. Again, the way in which I guess the presenter puts forward the presentation, is it responsive to the questions, are very important parts of that.
Well, what I was going to ask you is that for the companies that are going through the screening and who don't get forwarded on to the next level, and you would maybe know this more as an investor, what do you think are some of the fatal flaws that occur when the entrepreneur finally is given their moment to pitch, but they still are unsuccessful? Are there common issues that those who fail, fall into the trap of doing or not doing that holds them back from being successful?
So I guess it's a common theme about the team. You have to have a realistic understanding of what you know and you don't know. Before you go in to present as a screening or any place else, you need to find, if you haven't done it yourself, you need to find people who have. And you need to have people who are willing to listen to your practice. It's very important, that the demeanor of the presenter, not looking at reading a script is very important. And those aren't necessarily going to be fatal issues. Again, as investors, we're really looking to try to find out what's good about the company, what's investable about the company. How strong is the team? How tight has the company considered competitors? Has the company considered how long it's going to take in a realistic way to get it to market? Do they have a view on what it's going to cost to get it to market? But, it's pretty easy to come by example sets of slides and put together a set of slides that reflect the questions. Our application gives you pretty clear guidance on what we're going to be looking for. And you can use that application, to format your presentation and make sure you answer those questions. We also, we look for potential in the companies being screened. If a company is invited on to forum from screening, we have two of our sponsors who will spend time with them between the screening and the forum, coaching them on their presentation. And again, part of what comes out of that is an understanding of how well they take suggestions, how well they take coaching. If you're going to come in as inexperienced and you're going to come in as new, but you're really open to learning, you've got a pretty good shot at moving forward. If you're arrogant, if you're not open to listening to more experienced people giving you advice, you're probably not. That's going to come out, fairly clearly. But I'd say that kind of throughout the entrepreneurial process. I mean, entrepreneurship, you're working in a small company, you want to be very careful, not to believe your own story. You want to be very careful about expanding to other people, to talk to get views on. So, even now I'm presenting to a number of other angel groups. I find preparing for and presenting to other angel groups to be extremely helpful in ensuring that I'm not missing points, because at every angel group I present to, I'll learn things.
Well, I think you covered a lot of great points that the first-time entrepreneur sometimes has to learn the hard way before they spend the time and the investment in their presentation skills and having their quality of their content being challenged. But back to your venture is, so now you've received some commitments through the angel groups. You've been through due diligence. You have a sum of money that's been committed to you. Where do you go from there, Harvey? So you draw down if they've made a certain amount of commitment. Do you draw down the full amount, or is that contractually set up in a way where you draw it down as you need?
Yeah, it's always part of the term sheet in terms of whether there is a point at which you have an initial amount of money that you have to reach before you can take it out of the holding account. It varies, it varies from round to round. It varies on how big it's going to be. We're doing a raise through a safe. We're doing a small raise of $1,750,000. And we're going to be, drawing down the checks from the time they're written. And that's something that's, transparent to the investors. We have a number of programs ongoing. We have a manufacturing program ongoing. We have, preclinical testing ongoing. And we don't want to stop that. We need to keep spending against it. But, we're always ensuring that we're keeping enough in the bank that we more than cover, what our projected expenses are versus what we've drawn down.
It sounds like the financials and your projections are pretty important for accomplishing
Absolutely.
what you just described. I think a very common question is, again, for the first-time entrepreneur, and maybe those who do not have a financial background. From what you described for me and knowing your experience, I imagine the financials and the assumptions were a lot easier for you than other entrepreneurs trying to figure that out. Would it be safe to say, to guide them to really understand the assumptions behind their financial projections, or that's one aspect of it, but what meets muster when they're pitching to investors and then now they're starting to talk about how much money they need and how they're going to spend it?
Yeah, so your finances have to be detailed. They have to be sophisticated. And, there are a lot of ways of finding people that can do that. Again, you have to, I guess it's, about kind of recruiting advisors, recruiting 1099 employees, or not employees, but 1099 workers who are doing things on a per hour basis. But it's about finding people again and vetting them through your network, vetting them through, strong questioning on what have they done, how closely to what you're doing have they worked in the past. So, we have a fellow by the name of Steve Bello, who's a CPA, and is, a finance as a consultant. He works very closely with us. He's worked with us since we started. And he's great at financial modeling. That is the primary thing. So when we have, more sophisticated accounting questions or sophisticated tax questions, we turn to Eisner Amper. Virtually everything we're doing through outsiders. We have a company that is a QuickBooks bookkeeping company, very efficient, very transparent. And, you just develop the relationship with people who are running those companies, and, you react to how well it appears to be going. Again, I'd say in Keiretsu, the due diligence process, is just a tremendous way for testing that and building that. So, we had a couple of the people on the due diligence team from Keiretsu who were vetting our financial reports. And we had people vetting our technology strategy. And we developed, a really great and interactive relationship with them, where they were just kind of looking at us and, without anything, writing a report. We had very interactive meetings, discussions, some with the whole DD team, some with the individuals. And that was a huge, benefit for us. But again, it was about entering that process, saying that I understand that you're asking questions on behalf of the investors. You're not asking questions to be difficult. You're asking questions that if I listen to them and answer them fully, will help me build my strategy, build my business plan, and have a more successful company. And that's, we unquestionably came out of the due diligence with a stronger plan than we went into it with. We had, some really interesting insights and discussions about the platform that we were developing that caused us to pivot a little bit, and to come out with what I think was a much stronger approach.
So we're coming close to the end of time for the interview. So let's look at it from the point of view of the exit. So your therapeutic focus on metastasis is really, I would say, exciting. The fact that you're taking on cancer and in that form. So when you did your presentations and you went through the due diligence, so where's the exit? How long?
Yeah.
How long do you project out for the exit? And have you already identified some of the companies that might acquire your company, or is an IPO for your type of company possible?
So those are all great questions. To the last question, I'll say maybe for somebody else, but not for our team. So we're building this company and we're building our program with a target on acquisition, exit by acquisition. And I ran business development for Sterling Health in Europe and for Boots on a global basis, new product business development. And what I knew from sitting on the buyer's side of the desk was that I wanted to do business with people who I wasn't seeing for the first time when they wanted to sell me something. So we've started to develop relationships early. We've already been talking with people within companies like Merck and J&J, telling them about where we're starting, where we're going, asking them, what are you looking for from a company like ours, from a drug like ours? We did our homework in terms of researching exits. One of the things that really excited us is that, over the last several years, there have been several exits by companies with drugs that have focused on prostate cancer at very early stages. So in therapeutics, you go from the in vitro studies to the in vivo studies, animal studies, on to the what's called pre-IND enabling, which are the more classic animal programs, to your first in human clinical study, phase 1, then into phase 2 clinical study, and then into the large clinical studies. The large clinical studies can cost hundreds of millions of dollars. We'll never have and don't intend to try to build the resources or expertise to do those studies. Our intention is to exit at the end of the phase 1/phase 2 studies. We expect that's something around a 5-year horizon. So, when people look at therapeutics, frequently angel investors, early investors say, oh my God, this is a, 10 to 12 year program. It's going to take forever. It's going to cost several $100 million, maybe $1 billion. I mean, and yes, there are programs that, the big pharmas that cost $1 billion and sometimes fail. But most of that money, if you look at the spending of money, is in the late phase 3 studies, when the studies get very big and very complex. We're looking at a situation where we're pretty confident very confident that we can get through the initial clinical studies for under $10 million. And we're expecting that we can do that in 5 to 7 years. Hopefully we can do it in 5 years. That's what, our plan is for. And we've already started, again, it's like talking about the business development side. You can't start doing things the month before you anticipate wanting to be in the field. So we're already talking to the big cancer centers to find cancer centers that have actually led first-in-human studies, that have an interest in what we're doing. And we've developed relationships, with University of Chicago Med. We've developed relationships with Harvard. We've developed relationships with several of the New York hospitals. And now we're actively building our scientific advisory board and advisors, and already talking about different perspectives on the planning of the study. Now that study is still, 3.5 years from starting, but we're already looking at what the design is going to be and starting to put the plans in place for it. So answer to your question, we're focused entirely on an M&A. We have been identifying companies that have done these early exits, and these early exits have been for the big dollars, $1 billion to $2 billion. Merck did a deal recently where they spent $290 million as the upfront payment for a drug that's in early phase 2. And if that continues to work, that'll be $1 billion deal. And it should be for that company, in a 7-year time frame. So therapeutics doesn't have to be a lifetime pursuit. I have no aspiration to try to build this to an IPO. The unicorn is great, but it's not one that I'm going to ride.
So I actually, having now spent so much time talking with you about your venture, I'm quite excited for you, because it sounds.
So am I. Thank you.
Well, because I think it's your experience that's showing through, both on the angel and the entrepreneur side, that has given you a very clear mindset of the different stages that you're having to work through. And I think you've really highlighted so well the importance of having that network around you. But that also comes with time. So younger entrepreneurs or first-time entrepreneurs may not appreciate that as much as what you've accomplished in the last year or so. So I'll look forward, Harvey, to hearing some of your updates. And thank you for coming to Experience Voices. And I'll connect with you again. I appreciate it.
Jeannie, thank you. It's been a pleasure being with you on this interview. Appreciate it.
Bye-bye.